welcome everyone to the TIE Innovator Webinar series. I'm Jackson Weinreb. I am Director of Protocol Partnerships here at the TIE. And today we're joined by some awesome guests. We have Raj Parekh. He is the Head of Payments and Stablecoins at Monad. David Markley, the Chief Operating Officer at Exi. And Vasily Sidorov, the Head of Institutional Sales at Guide. So our topic today is going to be real-world stablecoin adoption. Specifically, we're going to focus on a few key areas. So we have, where stablecoins are delivering measurable benefits today, what breaks when you move from pilot to production, and what institutions require across infrastructure, custody, risk, and compliance to deploy at scale. So I'm really excited about this discussion and the different perspectives, each of our guests are going to be able to provide. Just a quick disclaimer, this discussion is for informational purposes only. It's not investment, legal, tax, or financial advice. So with that, I think we can start with a quick round of intros. So, maybe we could just kind of go around, and if everyone could briefly introduce yourself, explain how your organization supports, real world stablecoin adoption. So maybe David, we could start with you and then just go around from there.
Yeah, sure. Thanks, Jackson, and thanks to the TIE for hosting us. So I'm David. I'm the co-founder of Exi. Exi builds institutional-grade yield infrastructure for stablecoins. Our core product, Unity, is designed to turn crypto volatility into stable, predictable cash flows. And tying them both together, we view stablecoins basically as the Trojan horse for the financial system. They started as trading collateral. They're becoming global payment rails, which we'll talk about, I'm sure, here on this panel in a little bit more detail. But ultimately, we see them becoming treasury infrastructure. And once dollars live on chain, they naturally start looking for productive balance sheet management. And that's the layer that we're focused on building at Exi.
Awesome. Vasily, you want to go next? Okay, Vasily, you might be frozen. Not sure if you guys are seeing that as well. Yep, hear you now. You're good to go.
Yeah, thanks. Thanks for organizing. Vasily, I'm heading institutional sales at Guide, and we are building a financial infrastructure for the AI economy, meaning that we offer investors the ability to earn yield on the revenue that is generated by essentially providing the Am I frozen again? Or is it on?
Yeah, you did freeze. I don't know if you maybe want to try camera off for a second to see if that helps.
Yeah. Is that better now? Can you hear me now?
Yep, we hear you.
All right, yeah, cool. Sorry about that. Yes, so we're more focused on RWAs, which is a real world asset, which I guess is an extension of what David has just mentioned, where you have the institutions that are essentially going to be using stablecoins as a way of managing their treasury and moving money across different asset classes, across different geographies, across different platforms much quicker. So naturally, velocity and liquidity in many asset classes that used to be either very illiquid or inaccessible to a wide range of investors is likely to be disrupted. And we are trying to capture that with essentially focusing on providing the infrastructure for institutions to invest into compute and AI provision.
Awesome. Yeah, no, love that angle you guys are taking. And last but not least, Raj, if you want to jump in.
Yeah, sure. Excited to be here. First off, started my career at Visa. I was at Visa for many years, led crypto products there, launched stablecoin settlement many years ago. Hard to believe that we were talking about stablecoins 5-6 years ago back then, but then left to build my company Portal, stablecoin developer platform. We work with companies like World Remit, PayPal, many others that are building what I joke boring use cases with stablecoins and payments. We were acquired by the Monad Foundation, and so we operate as a subsidiary. Monad is a L1 EVM blockchain, really focused on high performance and building an open source payment system, where I also lead payments. So yeah, excited to be here.
Awesome. Yeah, no, excited to have you. Excited to have all you guys. And so, yeah, we could dive in. So question for everyone, and whoever wants to jump in first, feel free. When we're talking about adoption, right? So institutions, they're talking about real world stablecoin adoption. Like, what does that mean in practice today? How do you separate durable usage, things like payments, settlement, treasury operations, from activity that's primarily trading incentives or routing driven volume?
Yeah, I'm happy to go first. I personally think that, fiat and stablecoins will compete every single day for, whatever the optimal transaction flow looks like. So if I'm a treasurer that needs to send money ASAP and the banks are closed, stablecoins are awesome. If I'm, maybe okay with waiting 5 days for sending a transaction, then maybe Swift is actually okay. So I think every single day, I think treasurers, developers, companies are going to make a decision. And the way that I see these things play out, developers these days, even that are non-crypto native, is that they just think of blockchains and stablecoins as another rail. And there's a lot of high performance efficiency that comes with it. The 24/7 nature is obviously fantastic as well. So I think it's going to continue to vary based on use case, but I see every single day, both, the fiat system and the stablecoin system kind of intertwined and interconnected, and will both serve its purpose in its own way as well.
Awesome. David, Vasily, anything you want to add there?
I would just pile on that, institution has an umbrella definition that we throw around in this industry, and so I kind of think about it in two different ways. One is inside out, so these crypto native treasuries, these crypto native companies that are already building on these rails, and we work directly with many of them, L1s and foundations like the Monad Foundation, helping them achieve their cash management goals, helping them manage their treasury reserves, helping them, ultimately put their balance to work in the most efficient way as possible. And these teams already operate globally. And so they take advantage of all of the benefits that Raj just outlined, where they can pay instantaneously 24/7, 365.
Yeah, I guess just my quick addition here is that we also need to consider how far we've come over the course of the last, give it 5 years, where basically at first it was, people were confused when they saw USDT on Binance. They didn't know, what USDT meant. Was it a dollar? Was it something else? And I think it was really that 2020, 2021 that brought stablecoins into a relatively mainstream adoption with an increase of on-chain activity. And now, as the on-chain economy is also growing, and I'm sure that both David and Raj have been in the front row seat, taking essentially a view and participating in that growth. And obviously, it will have to grow with compliance and kind of treasury management and risk management and exposure to different stablecoins and different protocols, as we've also seen previously. But I think we just need to acknowledge that it's so young, and it's very impressive that only after really 5 years of being in public domain, we're already talking about things like tokenized deposits with the biggest names in banking, with the biggest names in Wall Street, tokenizing equities, and essentially using stablecoins to pay for all these things one way or another. So I think that's another major rail there.
Yeah, no, I think we've seen some really cool headlines around, stable coins and how that's leading to adoption specifically with institutions. And so I guess to follow that up, when we're talking about like KPIs that matter, right? What would you guys say is one adoption KPI that you trust most? And maybe one KPI you think institutions commonly misinterpret?
Yeah, I'll plug my former employer at Visa here for a second, but I think, Visa's done a really good job building its Visa on-chain analytic dashboard. And that's one that I particularly track because I think it does a good job of separating like true payment volume versus like trading volume that we typically see on-chain as well. And it also adds like some risk adjustments around, maybe some, just random anomalies or something along those lines that might come up in on-chain transaction volume. But I think, Visa just obviously being an incredible source for a long time. Transaction volume, but risk adjusted based on, some of these factors are important. I think you also start to look at, peer-to-peer or MTUs, monthly transacting users. I think these are also just like really important metrics. And I kind of think of it just coming back, from the fintech world. Like these are just KPIs of how fintechs and TradFi folks like think about it as well. And so those are just like a couple quick KPIs that I typically look out for.
Yeah, from our perspective, so I've had the pleasure of working in the crypto industry since 2017, believe it or not. And one of the things that we've watched over its progression, just as Vasily was mentioning, is how far we've come. And so a way to kind of capture and encapsulate that phase change is back, 5 years ago, 6 years ago, stablecoins held on centralized exchanges made up 60-70% of the total amount of stablecoins outstanding, something in that range. And then as you fast forward, and that number has come down dramatically. It's closer to 30% between the centralized exchanges and the DeFi collateral venues, right? And so I conceptualize that as a shift from pure trading, pure collateral, pure kind of the speculative use case of crypto into more productive use cases of crypto. So we've shifted the floor from 30% was used outside of the core trading use case to now it's 60-70% on chain that is more likely or more apt to be in the transactional phase. And so that's just been a massive phase shift. And oh, by the way, the market's grown exponentially in that time period as well.
Yeah, no, I guess that's bang on. In terms of the KPI that's kind of being misinterpreted the most, I'm not really sure. Sometimes I think about some of the other non-USD denominated stablecoins and how people want to compare, say, the trading volume of euro, pound, or yen in the forex market with US dollar, and they say that technically we need to see a similar growth, at least to the same proportions, in the stablecoin market as well. But that's not something that we are really seeing at the moment. I guess part of it is due to regulation and the fact that it's very different across the globe. Very different to a euro-dollar system that we've lived with for the past 20 years or so. But I guess this is something that we still need to come to terms with in terms of how we view different currencies and stablecoins in different currencies, and whether this is something the market actually needs, or whether stablecoins are just another vehicle to propone US dollar dominance on a global financial scale.
Yeah, no, I mean, those are all very interesting perspectives. So, appreciate all those insights from you guys. And, to kind of shift to more like use cases that survive production, right? So like looking at more, let's say, high signal deployments, what would you guys say are like the highest signal first deployments you're seeing today? It could be things like B2B settlement, payroll, contractor payouts, remittances, stablecoin backed cards are getting super popular. A lot of different, products solving for that. So in terms of all those kind of, examples, just curious, like which are most institutional ready right now, and why do you think that is?
Yeah, I mean, I'll touch on a few of them. I think the work that large remittance companies like your Western Unions, MoneyGrams, World Remits, I think it's like live in production. These aren't like things that they're just like talking about anymore. And there's like real usage, and I think the remittance companies see a lot of benefit for stablecoins and money movement. I think the other one is like global neobanking. We've historically have never seen the ability to launch a global fintech. It just hasn't really been possible. But the combination of unhosted or non-custodial wallets and stablecoins like present that new opportunity shift, and you're starting to see companies like Cast or Dollar App or some of these folks just like scale globally across multiple markets really fast. And then I think the other ones are, we're still early days here, but I think payroll with some of the work that Deal and and Gusto and some of these folks are doing today, we're just getting started. And the cool thing is that it's not coming from, hey, let's go like try this stablecoin thing out. It's actually coming from real pull from contractors that are getting paid overseas that are saying, hey, like, can you actually send it to me in stables versus this like crazy like long delays in Swift transactions or whatever that might be. And so, these organizations are very pragmatic. They're not looking for the next experiment. They're actually looking to solve a real pain point for customers and users. And I'm particularly really excited to see that stablecoins are not just an experiment, but like a pragmatic solution to like pain points that they're trying to solve for as well.
Yeah, David, Vasily, either you want to add to that?
From the institutional perspective, I mean, I mentioned it in kind of my opening. We view this all as the Trojan horse to treasury management, to take advantage of all the benefits that Raj outlined, right? Where you earn interest up until the moment you actually send the transaction. It's 24/7, 365. You have deep liquidity. You can have better return profiles. You can have access to all of the different types of investment assets that you want within a unified system. And so really, like, stable coins are just becoming programmable money markets for the internet. And we think that ultimately leads to investment in every type of tokenized product.
Yeah, I guess both Raj and David have hit the nail on the head here. I guess I'll just share my perspective on both kind of the more personal, kind of human interaction versus institutional. One is, say, 2 or 3 years ago, when I've asked my friends in the US, hey, can I just send you the money in stables because I've owed them something for when they're back in London. And then I had to essentially onboard them with a centralized exchange. Then they're like, this is so much worse than banks. Can you just not do me a transfer? And I was like, no, trust me, like it will pay off. You just do it once, and then you'll never have to do it again. And then that's been the case. Yield that exceeds treasuries with this, app number 1, app number 2, and it's just we're seeing how transformative it's been, not just for global payments, but also, as you've said, remittances and payroll and all these things. Like I think for the last year or so, any sort of invoice or payments that needed to go through with anyone that accepted crypto, that was always the preferred method. And anyone that doesn't is likely to have a board of 50 people, and all of them are probably over 60. Anyone else is really getting on the stablecoin train here for sure. In terms of kind of institutional adoption, again, David has highlighted brilliantly that it's a Trojan horse for anyone that wants quicker access and wants more deep access to the market. And the way we see it is maybe not just kind of building a global neobank like Raj has touched on, but also truly global money managers. Before they were, quite inaccessible to the wider public. It was, very much focused on the larger tickets. And even due to some of the laws and regulations, they may still not be accessible to your average Joe. But a lot more people can participate in things that were completely inaccessible to them before. And there were essentially gatekeepers that were charging them ridiculous fees to manage these funds for them. But now that you're going to be able to have different vaults that generate different yields across different asset classes, and you will essentially be able to participate in different activities like this on chain. I think this is a major improvement for the financial system as a whole.
Yeah, no, and I like that example, Vasily, of talking about like onboarding your friends to, accepting or sending stable coins. It's kind of like, you think back, right? We went from wire payments, then we had like Zelle, Venmo, Cash App get introduced. And now I think stable coins is like the next iteration, right? That is just like the true foolproof system of sending money to anyone, anywhere, at any time. And so with that, it's like we are going to see, I think, massive scale. We're all confident in that. And so my question to you guys would be, what typically breaks first when a stablecoin initiative moves from pilot to production scale? And that could be things like liquidity and redemptions, compliance workflows, accounting treatment, all sorts of things. But we'll kind of throw it to you guys to kind of get your insights on what you think kind of maybe breaks first.
Yeah, I mean, a couple things. I mean, one, you tend to see, real reconciliation differences. I mean, sometimes, some of these organizations, institutions have been so historically using, fiat rails or existing banking rails, and now you have to basically up level a treasurer to say, can you manage now another, other stablecoin account in some capacity, right? And then from there, manage like the liquidity requirements also. And I think that can create a little bit of strain on the team to like learn, but also also try to move the needle from like an innovation standpoint too. I think the other one is regulatory compliance as well. Like every market is so different. We're obviously in a much more favorable environment, especially across more markets now. So it's gotten a lot easier for institutions to build and actually get to production too. Like for some of the examples that I gave before. But those are the two that I think come up immediately as I've been working with some of these large institutions too.
Yeah, and Raj, just a quick question to like follow that up as you're seeing on the institutional side of things. Do you think institutions care more about upside or more about the potential failure modes? Like when they're evaluating this, like which factor is going to be, more important when it comes to that decision-making process?
Yeah, I mean, I would say like the biggest thing that I've seen is a lot of how traditional like global money movement is done for both institutions like back office treasury operations. You have this concept of a pre-funded account across all these different bank accounts, and that can get pretty tricky to manage. If I've talked to organizations that have 30 to 40 bank accounts where they have to manage a balance. You then have like a a high level mapping, and you're constantly monitoring the balances and like the risk associated with any of those bank accounts that you have as well. What the cool thing about stablecoins is that you can actually maintain smaller set of accounts, but then still like move that funds around really fast 24/7. Sometimes what these treasury operations have to do is that they intentionally keep money in like multiple time zones so they can get 24/7 coverage. But with stablecoins, it doesn't really matter. You could be in the US and still have a 24/7 operation. And so I think that's like some of the benefits that some of these treasurers see is that, oh, wait, I can actually manage my entire operations with less accounts, less overhead, potentially like a smaller team. And with all the AI stuff that's happening as well, you can even get more efficient around it. And so I think that's like the eye-opening experiences when you get past the compliance, the regulatory, tax treatments around the accounting parts of it, and then you start to see how it like fundamentally goes into your workflow, and that you can simplify it. I think that's where like the true unlock really happens also.
Yeah, and to pile on there, when we are talking with institutions about not only A, moving their money on chain, but then B, activating those dollars outside of stablecoin, denominated returns, their questions aren't which blockchain, what's your finality time, what's your TPS. It's what's the legal jurisdiction that governs this asset, what's the corporate structure, what if something breaks. To your point, Jackson, like they are trying to price the risk associated before they move their entire organization to new technology processes and figure out how to integrate the underlying. And so I agree. We're very much at the there's a lot of promise. Many of the treasurers recognize the cost savings, the benefits, the ability to streamline their operations. They don't currently have the tools to do that programmatically. That's being solved. And then once that unlock is done, then we'll see, the next wave of deployment across these various vaults.
And with everything that's been mentioned, I think risk and compliance definitely comes first. In terms of the benefits, I think everyone is kind of very well aware of them now, and it's not that larger guys would not want to move there, but it's mostly about as Raj has mentioned, in terms of your settlement, your accounting, making sure you account everything correctly across different jurisdictions. Obviously, if you're a payment processor, you need to be very robust in terms of kind of scanning the stable coins that you take, knowing where they come from, what's the transaction history behind that, etc., etc. And there's different tools that monitor the blockchain for red flags or anything like that, obviously. But then you also have a completely new framework from kind of say the AML and KYC perspective. Even if a person on your platform is KYC'd, if it's just a bank account, you also know the person that is sending money to this person. Whereas if it's a stable coin, yes, it gets a deposit to their address, but you don't necessarily know if it's their stable coin, if it's someone else's stable coin, versus they getting paid for a service that they performed, whether it's just a remittance payment, whether it's a gift. You just don't know, basically. And all of these things, I think, will play a part in terms of how the regulators view the space as well. I guess just to plug my UK perspective here, and there has been a very heated debate in terms of kind of the central bank's approach to manage the stable coins midway through last year, midway and towards the end of it. And I think they're beginning to reconsider their originally very, very strict criteria in terms of how many transactions and how much value can individuals and corporates hold in stablecoins. I guess after, they spent some quality time with a few of the industry leaders, they just understood that despite all the challenges, the opportunity is so big that we need to just sit down and solve these issues. Otherwise, we're just missing out on something really big here.
Yeah, no, appreciate that insight, Basley, and David and Raj as well. I think from here, I kind of want to go deeper into infrastructure and what actually scales. And so I have some specific questions for each of you, given the unique perspectives I think you all can provide. So Raj, I'll start with you in regards to like enterprise grade payments. So from a payments builder perspective, what would you say are the top 3 minimum components required to make stablecoin payments enterprise grade and scalable?
Yeah, I mean, it definitely starts. I mean, we'll start with the base layer first. And I mean, just to give you guys some context, when I first launched stablecoin settlement at Visa, we used Ethereum mainnet, and obviously very expensive. And we know all the issues and bottlenecks that really took place there. I think fast forward, like almost 5, 6, 7 years later, I think now you have chains like Monad that have perfected the EVM, but you have no throughput issues. You can actually meet Black Friday level demands, right? From like a stress standpoint, right? A tenth of a penny. I still remember the transaction that we did before on the Visa side. It was like $10, $15 for a transaction. Like we're not even, doesn't matter like, if you can move stablecoins 24/7. If the transaction fees are still like equivalent or the same as like a Swift transfer, like we have a long way to go. And so I think the base layer is really important. And so obviously like chains like Monad do a really good job of that. And then I think as you go a level higher, some of the things that are really important is just like how you actually position your product also. I think oftentimes what we've done in the crypto space is that we've showed the guts of crypto to the end user, to the institution, to a treasurer. And that's just scary. Like if if you press the wrong button, all of a sudden you've sent the funds somewhere else. And so I think sometimes even how you position the product, making sure it's fully abstracted away, you're not showing, RPC nodes and, all the different like random things that we require from a crypto transaction standpoint. And I think as you just go, one other level higher as well is that it's about, I think, just how you actually enable the full workflow into like you have it fully integrated into a workflow for an existing system. Crypto shouldn't just be like a standalone product; it should actually be fully embedded in. And so, I think just to summarize, like really, strong base layer. From there, go a level up in like how you position the product, making sure that it's actually meeting. You're not showing the guts of crypto. You're actually like abstracting some of the complexities away. And then I think full integration into the workflow. It shouldn't be a standalone separate experience. Like once you have it fully embedded in, now as a treasurer, you can be really strategic. You can say, cool, like I know when to leverage stable coins. I know when to leverage the traditional system, and I could kind of marry both worlds together. And that's where like the true unlock really happens as well.
100%. Yeah, I think it's like, how you can extract value from both ends of the equation and then seamlessly connecting the two sides from both the traditional world and then from, the stablecoin perspective. Um, and then now kind of focusing more on like the institutional treasury view of things. So David, this question will be for you. So when we're talking, institutional operations and from that perspective, what must teams see before they'll use stablecoins as a settlement asset in production?
Yeah, a couple of things. I'll start just by explaining the core product that we offer today, and then we can double back on what the necessary requirements are, right? And so the backdrop is, there's already $300 billion of stable coins that are out there today, right? So institutions are holding billions of dollars of digital cash. The next step from our perspective is ultimately making those balances productive without introducing opaque risks. And to Raj's point, not only have we done a disservice by showing the guts of crypto, but sometimes we muddy the waters by naming things or embedding risk in places without fully disclosing or showing what's under the hood. And that's really gotten us in trouble over the years. And so that's the role, is to demystify and show what's actually under the hood, to make available and fully transparent. And that's why we think our product Unity is a treasury grade asset. And that's the role that it's designed to fill. And to double click on that, really it's a stable position designed for treasury management, backed by market neutral strategies. And so instead of holding volatile crypto or even idle stablecoins where you're not potentially earning, institutions can hold Unity, and you have that maintained stable value. You generate rewards from crypto market inefficiencies, but you also avoid the crypto directional exposure. And so you can think of it conceptually much closer to a crypto native treasury bill or the crypto native interest rate, as opposed to taking a directional bet on BTC, ETH, or otherwise. And so with that context, what we work with institutions on is liquidity and redemption mechanics, right? Making sure that they fully understand what the redemption process looks like, what the subscription process looks like end to end. What we provide is a 24/7 transparency dashboard, so all of our counterparties can see through to the underlying positions in real time. They can pull it into their own database. They can use our own out-of-the-box monitoring tools. And then, of course, strategy risk limits, right? I mean, this is kind of the key thing that we have done a poor job as an industry, is being explicit about these are the things that this vault will and or will not do. And so we codify that. We make sure that it's very easy to understand. And then we try and put it in a package that integrates with, if you're on chain today, or if you're crypto curious and the only interface you have is a Bloomberg terminal. And so we try and bring the access points to where the capital is.
Yeah. I mean, I think transparency is probably the most important thing, right? If someone's going to be deploying into a vault, they want to know, where's that money going? How's it being managed? I guess a quick follow-up question for you, David, is like, where do you find that liquidity threshold is, right? For LPs, investors deploying into the vault, do they need instant liquidity? Are they willing to wait 2, 5, 7 days? Like, what do you typically see now?
Yeah, it's a great question. It's really a conversation around portfolio strategy. And so, it's not a one size fits all, as Raj mentioned. Maybe you're comfortable with a 5-day settlement period. Maybe your organization is working on the margin and you need, the ability to unwind and top up somewhere else instantaneously. And so we work with a lot of the crypto native institutions that manage all of that on chain. And then we also work with bringing these products to traditional asset managers and traditional fund managers who, have just a wide array of operating requirements. And so to answer your question, it's not one size fits all. We have some people who are willing to, pay a premium to have immediate liquidity, and we have others who are willing to wait T+30 or even longer. So
yeah, I guess if the yield's there, people could wait longer, right?
That's correct.
Nice. And then lastly, we could shift over to you to more on like the AI and compute side of things. So
Sure.
From the vantage point of AI infrastructure finance and real world compute cash flows, where do stablecoins create the most immediate settlement advantage?
I guess from what we've seen so far is the ability of investors to get access to a market that one is quite new, and two is quite segmented. So there are obviously credit funds, some of the lending desks at banks that do lend against GPUs as an asset and engage in this asset-backed investment. But obviously this then sits on their balance sheets, on that credit fund's balance sheet and on that bank's balance sheet. So only really the shareholders and the LPs in these institutions have access to that. For us, the main goal was to bring that on-chain and democratize access to these sorts of investments, and also make pricing more transparent. And obviously going down the line, once more institutions are allowed to join this tokenized world of tokenized equity, tokenized debt, tokenized loans, then they're going to be able to trade in and out of these assets much quicker than before. Now you need to either write an email, pick up the phone, get on the Zoom call, and try and get the quotes from a consortium of investors, versus if you can just do all of it on-chain and receive your settlement instantly with stablecoins, and then either transfer it to fiat if you need to, or use your stables as a part of your treasury management strategy, as David has mentioned. I think this just opens up this relatively new and relatively opaque market. It just gives more transparency and gives access to a wider group of actors to participate, and all of that is thanks to stablecoins.
Yeah, 100%. Appreciate that perspective there. And so, going like beyond payments, I think institutions increasingly care about treasury utility. And David, we were touching on this a bit just now. We could dive a bit deeper. But I think, it's like, how can institutions put their stablecoins to work and earn actual yield on their dollars? And so, David, I guess we can kick this off with you, for this part of the discussion. But would love to learn more about Unity, UTY, which I don't believe is a governance token. I guess you would classify it as your yield-bearing stablecoin, but you could correct me if I'm wrong. So from an institutional audience, what's the clearest way to explain Unity and what it is and what it's not?
Yeah. As I kind of outlined at the top, let me take a step back and just talk about XE broadly. We are building institutional grade yield infrastructure that's on top of crypto, right? That takes advantage of the market inefficiencies and the opportunities within the crypto market. The first product, given the backdrop that we've talked about on this webinar, is that we think there's a tsunami of money rotating out of treasuries and money market funds, the $7 trillion pie that many of us are looking at. We think that starts to rotate into stable coins. We've already seen that wave and that momentum start. We think that grows from 300 billion a day to 500 over the next 18 to 24 months, give or take. And then from there, we think that 500 will rotate into vault yield opportunities, for lack of a better term. And those vault yield opportunities, roughly 15 billion-ish in terms of total amount of capital deployed. And so even if you think, or slightly less than that, growing to 15, we think relatively quickly. But even if you think a small fraction of this, 500 billion in future stable volume rotates in and tries to become more productive, that's the opportunity that is right in front of all of us. And so then there's a question of, okay, what's the variety? And you can do things like Vasily's offering, where you finance AI and compute, or you can have things that are more like crypto native treasury or crypto native interest rate. And so under the hood, as I mentioned, it's market neutral strategies. We use basis, if you're familiar with that particular cash and carry or basis strategy under the hood, but basically democratize access to the long tail of the crypto market complex. And so by this structure, you can take your normal stable coin that's yielding 3-4% from treasury bills. And then of course, if rates come down and those rates get compressed, you can now deploy into other diversified types of strategies, whether it's ours or Vasily's, but it just opens up the opportunity to participate in the crypto market, where I just don't think historically it's even been an option or something that a treasurer who would have to go hire a trading team on board with all of the centralized exchanges, set up custodial infrastructure. We collapse all of that complexity and make it a lot easier for people to programmatically participate.
Yeah. And again, it's, you kept alluding to whether someone's earning yield in XE or, in Guide. There are different ways, I guess, folks can go about it in terms of the strategies that you're running. Obviously, XE and Guide are two totally separate, exposures to different things, in terms of how you're generating that yield. And so I guess vastly jumping, back to you now, when we're talking about productive dollars and AI-backed, workflows, from an institutional perspective, and when they're evaluating, productive dollars or productive dollar models, tied to AI infrastructure, what are the non-negotiables there?
I guess from their point of view is obviously more on the actual deal structure and how secure the end borrower is and how valid the operator is, etc., etc. But bringing it back to kind of our point of conversation here is, I think, the main difference between what can be accessed through David's product or any other offering that is based off your kind of crypto native liquid strategy is the liquidity profile. Since for us, as for any other
I think you froze there. If you maybe want to try camera off.
Forgot about that. Sorry. If you go and consider any RWA, be it us with compute or anyone else for that matter, linking stablecoin infrastructure for aggregating investments and then making repayments and making it accessible on chain. Obviously, there is always a point where the money needs to convert from stablecoins into real dollars. At least that's the case for now. And that's the case with us in many cases where you can only really purchase GPUs via a bank transfer. So you have to off-ramp and then essentially recalibrate your position back to stablecoins and then return the money to investors with interest in stablecoins. So that's kind of the level of complexity that we're completely abstracting away and doing it ourselves. But also, I think, just coming back to the original starter of the conversation of how far we've come over the last 5 years, I think even things like real world assets, again, be it Gaib's offering GPU backed yield, or any other company offering yield backed by automotive credit, or be it trade financing or anything else, as more and more flows actually move to on-chain settlement and stablecoin settlement, then the need to convert to fiat and the need for stablecoins to be converted and essentially leave the space will diminish, as people will be able to get the funding of stablecoins, then acquire the necessary assets in stablecoins, use these funds for working capital in stablecoins, repay these loans in stablecoins. Then this will just make everything move much quicker and will be much more transparent for the investor as well, for whoever is managing the money on their end.
Yeah, 100%. And, jumping back to Raj now around earn and spend integration. So Raj, if stablecoins are to become, let's say, day-to-day money, how do you integrate yield without breaking payment UX and liquidity expectations?
Yeah, I think first off, I've been, really surprised, like pleasantly surprised from like some of the institutions and fintechs who actually asked me about like Morpho or Aave or yield options as well. I think from like on the earn side, I think what's been really interesting is that over the last 5-6 years or so, as like the DeFi ecosystem has really grown, it's actually become pretty anti-fragile, and it's battle tested. And I'm actually starting to see like more confidence in the institutions saying, hey, we're happy to work with Morpho or Aave. And there's a lot of really exciting announcements coming up around that too. And then Monad, both Morpho and Aave are live today, and it's something that we're starting to see like more institutional interest around. And I think they've done a really good job of just really focused on building credibility for that, for that specific segment. It's easy to build credibility with the crypto native folks. It's much harder to do with the institutions. And so that's something that I've been particularly really impressed with. And I'm excited to do more with those protocols, and from there start to enable really interesting vaults that then earn, for different institutions or use cases. And I think the great part about this is that a lot of them do have an SDK now where you can actually embed them into your app in some capacity. And so we're starting to see like a shortening of the user experience between the end user or the business over to the actual protocol to earn yield itself as well. And so that's being further abstracted away. And so the credibility, the robustness, the anti-fragile nature of DeFi, plus like just the hard effort on like security has now earned the credibility for institutions. And so I think that's one that, we're obviously really excited to work with those teams. And then I think when you bundle it all together with the spend side, to your point, stablecoin cards, I mean, I've, being at Visa for many years, like I have an affinity for cards, and I think it's an awesome product as well. You get access to 300 million merchants also. I think that's another shortening event for stablecoins, where it does have access to like buying your coffee at Starbucks, or just buying groceries also. Or if you're a user overseas and you really want to operate in dollars, you don't really want to operate in your own local currency anymore. These card products become really, really powerful tools. And so I actually feel like the maturation of the card issuance space with companies like Rain and like Morpho and Aave, on the DeFi side, we actually have a really, really strong packaging for both institutions, treasurers, developers, enterprise fintechs. Like it's like probably the most exciting time to build, because you can actually trust these products also at institutional scale.
Yeah, 100%. And obviously infrastructure is one thing, but risk and compliance determines whether this goes institutional. And so, yeah, no, compliance and risk management, not the sexiest topic, but very much an important one nonetheless. And so, for Vasily, to kick this off, like, what does an institution-ready custody and operational risk framework look like for tokenized real-world portfolios?
I guess the number one important factor, again, would come down to how prepared you are in terms of your kind of internal controls, and how confident you are in the custody provider that you're using, in kind of all of your internal compliance and risk management, which I guess spans across the industry as a whole. It doesn't just touch RWAs, but probably also is involved in any other sort of money management activity. That could be, liquid strategy, could be hedge funds just trading off centralized exchanges and DeFi, could be anyone doing arbitrage. The setup is important. You need to be 100% sure in what you're using, and you need to make sure that the client's funds are secured, that you're not exposing yourself to any unnecessary risks that you really shouldn't be bearing. And coming back to Raj's point, I think now we have reached that point where you can actually trust these providers, which really wasn't the case even 5 years ago. There are maybe like 5 names in total that you could trust with custody, and then a few of them either raised questions in the last 5 years, or some of them have disappeared completely, which were considered a solid option. Thankfully now I think all of that is more or less behind us. We know the best practices in terms of how money should be managed on and off chain. There are different controls that you need to always update and always monitor. And I guess from our RWA specific side of things, we need to make sure that our schedule that we promise our investors in terms of the liquidity and the alignment of whatever investments we make off-chain actually matches up with the liquidity profile that our investors expect. Because obviously if you deposit on-chain through the vault, you're still bound by certain liquidity aspects. And GPU-backed loan is not the same as a treasury bill. We try to make it more liquid. We try to make it more attractive for a wider pool of investors, and we try to essentially bring it to a wider market. But you still have to keep in mind that this is essentially more of a private credit and private equity type of play with the same repayment profile and same liquidity profile. Using stable coins for that may help it in the future as the use of them grows and the industry matures. But for now, there are still trade-offs that you have to live with. And I guess just keeping that at the back of your mind that even if it's done through a stable coin, is never going to be as liquid as a U.S. Treasury bill. I think that's an important consideration for any investor looking into RWAs as well. Because as David has mentioned, there are some guys that operate on margin and they need instant liquidity. They need to be able to shuffle money around very, very quickly. And then obviously they will look at us and they will probably need to see where exactly we would fit into their investment profile. If it's market makers or any of the guys that do kind of high frequency arbitrage, I doubt that our core product would be of much use to them. But if you're a family office, if you're a private credit fund, if you're a private equity fund, and even if you're a foundation and you're trying to diversify your exposure and you're trying to do it in a transparent and compliant manner, this is where we come in, and these are the guys that we are mainly serving at the moment as well.
Yeah, no, thank you for all that insight. And while we have just over 5 minutes left, going to jump to David here. So David, what does institution-ready custody and control model look like when we're talking about treasury and yield products and how they interact, with venues and hedging tools? You're on mute, David.
So Jackson, you opened with, you didn't think that compliance was very sexy. I'm going to push on that statement because for me, it finally shows a maturation of this space, right? Risk management is not who can hit the sell button the fastest when markets aren't going your way, right? Risk management happens long before you actually enter your position. And we're finally starting to see the crypto industry mature into using tried and trusted frameworks from traditional finance, right? And so coming back to the compliance, the custody, the counterparty risk, this is the question that we answer for our partners every day. It's what is the legal jurisdiction? What is the corporate structure? What happens when something breaks? Who controls the assets? Where do legal claims occur? What recourse exists if the strategy, the company, or any of the counterparties in the loop fail, right? I mean, this is like the foundation, the 101. And having been a practitioner, I can tell you that majority of the capital in the space was not asking any of these questions, several years ago, right? And so from our perspective, obviously doing this, like, craftsmanship matters. And so doing it with the right partners that are structured as trusts or have bank charters as an example. So we use Copper Clearloop as one example under the hood. We also partner with Anchorage, another great custodial firm. We work with Coinbase, names that most people I think are probably familiar with at this point. And we use that off-exchange settlement infrastructure to minimize the counterparty risk throughout the rest of the crypto ecosystem. And so to Vasily's point, we're at a maturation point where traditional capital can actually get comfortable with the counterparty risk that they're underwriting, in addition to the smart contract and the programmatic risk, because places like Monad exist that have been battle tested and have the right infrastructure in place, where now this capital can actually flow on chain, where it can actually be deployed. And it's less about 40% APY when moon, and it's more about, talk to me about the core, kind of meat and potatoes of what you've built.
Yeah, no, I love that take, David. To hear a DeFi founder, say that compliance is indeed sexy, it shows this industry is maturing. So I love to hear that, and I love that take. So thank you for that insight.
We're making compliance great again.
There we go. It's all about compliance, not about the 100x.
That's right.
And then Raj, jumping to you. When we're talking about payment and settlement programs, what are your non-negotiables at the infrastructure layer?
Well, I mean, compliance and, I'll jump on that again, but I mean, obviously, like we have to make sure all these flows are compliant. So that's, I think, critical. I think from there, like liquidity is really important. Like we have to offer, best in class spreads, yield management, whatever that might be from a settlement standpoint too, because some of these treasurers are having to manage, T+2, T+3 settlements today, and that's a lot of money just in transit, and the opportunity cost for that money in transit is actually really, really high as well. And so if you can shrink that down to T+0, and then you start to like really enable some of the yields as well. Like these become like the 10x opportunity that we want to showcase to some of these treasurers also. I think the last but not least is that we got to just make this thing user friendly. Like it's just we can't expect everyone to be setting up a MetaMask account and playing with these protocols. Like that's just not going to be realistic for the future. And so it's been awesome to see just like companies like the remittance companies or these fintechs that are just innovating at the product level, and even like folks that are just building best in class like treasury infrastructure as well. You just have to make that simple. And I think in the way I think the example I like to give people is that today you probably use your Visa card every single day and you go buy a cup of coffee. You have no idea how Visa works. Most folks don't. And that's actually totally okay. Like you don't need to like share all of that, underlying, what's happening underneath the hood. Like blockchains like Monad should just work, and the transactions should just go through, and this, the liquidity should be there, and the stable coins, should be received by that recipient as well. Similar to how a Visa transaction gets completed when you buy a cup of coffee. I think we're getting closer every single day. But I think that's the reality that we need to get to, and so those are some of the non-negotiables that we have to have as part of every workflow.
Yeah, 100%. And while we still have a few minutes, we're coming up on time. I have one last question for all you guys to kind of wrap this up. This was an amazing conversation. So, in one sentence each, what's the single biggest milestone you expect to hit in the next 3, 6, or 9 months that's going to prove real world value, for institutional participants? So Raj, maybe you want to kick us off there.
Yeah, I mean, we're excited about the growth of institutional DeFi, and yield, and so I think we're well past multiple billions in TVL on Monad, powering many institutions, and then continuing to see the stablecoin market cap grow. So those are some things that we're really excited about.
David?
I'm going to use a couple of sentences if you don't mind. So to kind of put a bow on this whole conversation, stablecoins didn't just digitize dollars, right? They've turned money markets, they've turned yield into software. And so the institutions that take advantage of that opportunity of how to manage that capital will effectively define the next financial system. And so we at XE, again, our whole premise here is to build institutional grade yield infrastructure. And so we're focused on supporting these treasuries, whether it's an L1 or a foundation, supporting high net worth individuals, supporting RIAs as they want to take advantage of this massive opportunity that's in front of all of us. So that's what we're focused on. We've got our first product in market. We'll be launching several more alongside so that these treasury operators and these managers can ultimately operate from a single pane of glass.
All right, Vasily, take us home.
Sure. I guess I'll also touch on 2 points. One is obviously we are very looking forward to the expansion of RWA space as a whole, given the latest developments that were happening in the space over the last year. We're very, very positive in terms of where everything is going, both regulation-wise and how comfortable the investors and the LPs are with what a real-world asset is. And to have essentially an on-chain receipt of your real-world asset investment. And in addition to that is obviously we're very excited about the AI build-outs, all of the demand that comes from the data center and infrastructure build-outs globally, not just in the US, but also we're seeing demand come from Europe, from Asia. And I think 2026 is going to be a year where even more deals will need to access reliable and competitive financing, and we're very much looking forward to bringing it to the market.
Awesome. All right, I think that was like an hour on the dot. So great job, guys. We kept it right on the money. But seriously, thank you all. This was a super thoughtful, informative discussion. Hopefully after this, we're going to see Gybe and Xe deploying them Monad natively and, getting more LPs to deploy there. So I think there could be some good synergies. But yeah, thank you guys. Thank you to everyone who joined us today. And, looking forward to, future conversations. So this was awesome, guys.
Appreciate it, guys.
Thanks all.
Thanks, gentlemen.